Hi again, everybody. This is Jim with another episode of Quarterly Deep Dive. Today I'll be looking at a company that used to be a retail favorite back during the 2021 bull market, and which still kind of is, Crowdstrike. It's probably a bit more exciting company to discuss for most people, or at least me, because of just how important their work is in the field of cybersecurity for the US government and some of the most valuable companies in the world. I'm not a cybersecurity specialist, so I'll try my best here to keep this input neutral from me in that regard and just focus on the history and fundamentals of the thing. So, Crowdstrike was founded in 2011 by George Kurtz, Dmitry Alperovich, and Greg Marston. These guys were industry veterans who jumped ship from McAfee and Foundstone, and from the first instance, this company was envisioned as a firm that would deal with cybersecurity on the scale of international actors and some of the most dangerous threats out there. Shortly after forming, they brought on Sean Henry, who retired from the FBI, and who still serves as their president of CrowdStrike Services. Since that time, they've gained notoriety for their work on a large number of really high-profile incidents that include helping the DOJ charge Chinese military actors in 2014, uncovering North Korean involvement in the Sony Pictures hack that also occurred in 2014, and identification of the members of the Russian and Chinese hacking groups Energetic Bear and Putter Panda that same year. In 2015, they discovered vulnerabilities in the open source emulator QEMU and discovered evidence that Chinese hackers were targeting US tech and pharmaceutical companies in violation of a recent agreement that Xi Jinping had made with Barack Obama. They've now continued to grow in the past 7 years and are pretty much involved in most major hacks that are important enough to make the news. Their work most recently included uncovering the SolarWinds Microsoft vulnerability that was suspected to have been used by Russian hackers, and when not in the news, they closely monitor hacking groups around, such as Russia's dark side that was behind the Colonial Pipeline hack. In addition, they prepare an annual global threat report every year regarding the most serious cybersecurity issues facing the world. So if you want to learn more about the company or the granularity with which they monitor cybersecurity threats, that might be a fun place to look. While the whole high-profile stuff is a bit more fun, the majority of their income comes from subscription services to their software to guard endpoints, and as of the last quarter, they provide cybersecurity services to 65 companies out of the Fortune 100 and 254 out of the Fortune 500. While the story behind this company is definitely an exciting one, an exciting story doesn't necessarily equal a good investment, and for that we have to look at the fundamentals. In the first instance, we're looking at a market cap at the time of this video of just north of 44 billion. So they do dilute, although maybe not as bad as some other high-profile tech companies, with shares outstanding at 213 million now compared to 196 million back in 2019. This company trades at a heavy premium with a forward PE of 159 times earnings and a price to book of 40. The stock has come down a bit now from its high of $284.30 in November of 2021 after IPOing for $34 in 2018, and it's currently trading in the 190s. So, like most companies that trade at premium, our first question should be, why are people willing to pay so much for the stock compared to other companies that earn more money and whose stock can be purchased more cheaply right now? The answer here is totally explosive growth and a strong moat. In 2019, CrowdStrike accomplished revenue of $250 million for the entire year. Now they make that in a quarter, having sales of $487 million in Q1 of 2022, a 61% increase year over year. For 2021, they accomplished $1.45 billion in revenue, or growth of 66% year over year. They also managed to grow their subscription base in Q1 of 2022 by 57% year over year. So we know they can grow. They have close ties to the US government and some of the most valuable corporations in the world, and international tensions could be fairly said to be a little high right now. So their moat, or base of sales, that is likely to be difficult to shake by tough times or random events is also considered to be pretty strong. What I'm going to want to know next is their income, their net margin, and their cash flow. That way I can tell if this growth is coming from momentum that suggests the company will eventually be able to make serious profits they can use to grow their savings, have potential to start really delivering rewards to their shareholders in the form of dividends, buybacks, or anything else. Their net income last year was not very good and generally going the wrong way. They incurred a loss of 2017 of $135.49 million, a loss in 2018 of $140 million, a loss in 2019 of $141.7 million, a slightly better loss in 2020 of $92 million, and 2021 they lost $232 million. I'd argue that this picture misses a lot of the momentum they've recently had with their quarterly numbers, where they've been going from a loss in 2021's Q1 of $82 million, Q2 of $57 million, Q3 of $50 million, Q4 of $41.7 million, and Q1 of 2022 at $30 million. So, at least very recently, this income picture is getting a lot better. Next, I want to look at margins. If we're selling a ton of services but losing money every time we do, eventually that's going to prove problematic. Here the picture still isn't where we want to be, but improving a little bit more obviously than income. We have negative 114% in 2017, negative 56% in 2018, negative 29% in 2019, 10% in 2020, and negative 16% in 2021. Just like net income, the quarterly picture looks better, and in Q1 of 2022, they had net margins of negative 6.46%. Okay, now most importantly, we want to look at cash flow. Cash flow tells us how much money the company is bringing into the business before they invest, reward employees with shares, pay taxes, or incur any number of other expenses that end up in the final net income calculation. Here, the picture is a lot better. They had cash flow of negative $58 million in 2017, negative $22 million in 2018, $99 million in 2019, $356 million in 2020, and $574 million last year. This keeps going up on a quarterly basis, and in Q1 of 2022, they pulled in $214 million, an increase of 45.7% year over year. So if they're bringing money into the business overall, why are they losing money on the bottom line? A big thing with this company is expansion of expenses for marketing, R&D, and stock-based compensation. Year over year, they spent almost twice as much as the year before on all three in Q1 of 2022 versus Q1 of 2021. They're taking a profitable picture and making it less profitable in order to make sure that they have better cybersecurity services, make sure that their name is out there and people are buying their products, and to give employees a stake in the company that still decreases the value of the company, but allows them to preserve their cash on hand. Speaking of which, when we look at their balance sheet, they have $2.15 billion in cash currently, compared to $1.996 billion in 2021, and their assets have improved from $3.8 billion to $3.8 billion from $3.61 billion. At the same time, their liabilities have gone up by just a little less, at $2.718 billion compared to $2.58 billion at the start of the year. This might not be so bad though, as a lot of this is made up by deferred revenue or sales that have already been paid for, but they still need to deliver. So basically, the full picture we have here is of a cybersecurity company that trades at a pretty heavy premium, but which is growing rapidly and has a growing base of extremely high-profile customers that rely on it heavily. It does come in pretty late on a traditional price-to-earnings metric, but that also appears a little worse than it probably should, given the optional expenses they've been incurring to deliver the best product possible so they can keep growing. The bear case here is definitely going to focus on that multiple in a market that's on edge with a global slowdown and high interest rates, while the bull case would probably focus on the continued rapid growth in cybersecurity that's happened amid higher international tensions, the cash flow and cash on hand that the company can fall back on in a pinch, and the recent success of peers like Palo Alto on their earning beats. The street is looking tomorrow for revenue of $516 million, coming off of $323 million from the year prior, and 27 cents a share versus 11 cents a share the year prior. I myself am not expecting massive movement on this one from a standard beat, given its general outperformance in the last year relative to other high multiple tech stocks, but Palo Alto's recent 10% jump after reporting a beat on earnings would probably beg to differ. So that's Crowdstrike. I hope you've enjoyed this video, and if you have, please like and subscribe. See you next time.